Everybody, it's Michael Martin. Thanks for being here. So, as I've been building out the YouTube channel, I've been getting a lot of great feedback. So, thanks very much for liking and subscribing to the channel and to make the comments as you've been. I appreciate it. I'll be trying to create more content along the lines of what you like based on the analytics. So, an interesting thing happened because I had recorded a lot of video way back in the day. And so I went through my computer and I found some old stuff that might be good for the audience today. Because as I do, I create stuff that's kind of evergreen. And I found this old video that I had done with Bill Dunn, who has since retired. It's probably 13 years old. I remember it was before I shaved my head. I know we recorded it at Chateau Marmont on Sunset Strip in Hollywood. And it was really, really interesting. Bill was the chairman of Reason Foundation at the time. And so we have a lot in common. I've known him for a long time. And he was willing to sit down. We've recorded it. It's a blast from the past. So I look very different. So does Bill, but it's a very informative video. Now, Bill Dunn is a purely systematic trader when he was trading. Like I said, he has since retired, and a man named Marty Bergen's running Dunn Capital. So Bill's largely out of it. But Bill's a very interesting guy because he was a purely systematic trader. So he built models that he changed from time to time. Not a lot, but little tweaks here and there. Ultimately purely systematic. I only know of one discretionary trade that he took that he admitted to me, and that was when all the Y2K fears were in place. So coming into December 31st, 1999, no one knew what was going to happen with the computers as all the clocks went to 00 basically, and so they went to cash. But other than that, that was the only discretion in a career that I think goes back to the early to mid 70s. I want to say 74 was his first year running money publicly. But it's very, very interesting to see how this man thinks. And I think you'll get a lot out of it. There's a lot of wisdom here from an old timer who was really at the very, very beginning of what we would consider managed futures, right? If you go back to the 70s, there was Commodities Corporation. There was obviously Continental Grain, Archer Daniel Midland. There's Keith Campbell from Campbell and Company. Of course, there's John W. Henry, owner of the Red Sox. And I think he owns Liverpool too. Largely, they're just running firm money anymore. Then there was Bill Dunn. So a lot of those folks have really kind of seen the industry grow from a little cottage industry where there were 10 entities doing managed futures to what it is today, which is a booming industry. But anyway, I think you'll like the video. Bill's a great guy. So enjoy the show. Leave some comments. Tell me what you think. Bill, how'd you get involved in Reason Foundation?
Back about 12 years ago or so, I became aware of the magazine and I was reading it. And then they had what amounted to the first Reason weekend in their offices here in Los Angeles. And I came out and participated in it and found it to be quite stimulating. And John Stossel was there, and I was pleased to meet him and see the good things he was doing. And I became a supporter. And the next year, when they went out to Napa Valley at the Silverado Club, I signed up to go. And they said, well, they were going to have a board meeting. Would you be willing to join the board? And I said, sure. And I got a good vote. And so I've been there ever since.
The motto of the magazine is free minds and free markets. Who would be opposed to free minds and free markets in this day and age?
People and the groups that would oppose free minds and free markets are the people that would like to run other people's lives. That generally comes down into governments or people that work for governments. That includes teachers, schools, bureaucrats of all kinds, because they would much prefer to run those economies, and they kind of think that they could learn how to do it, and they really do believe they could do a better job than the free market. But it seems quite unlikely that that's true. It hasn't been so far. The advances in economic well-being all around the world is because of the emergence of more and more free markets, and it does require free thinking to do it.
So that's very pithy. Do you think it's about power then?
Yes, and arrogance. Both, they're related.
Right. Popular media would have it that speculators offer no value, and that whatever gain they get, they gain at America's expense. What's your take on that?
I think the modern use of the word has all sorts of pejorative connotations because the people that use them use it that way. Really, they're really two main participants in markets, and they're buyers and sellers. So if it happens that some commodity, such as oil, tends to rise or does rise in cost, it hits everybody, and they get to hurting. And so people say, well, here's the problem. The speculators have driven that up. And clearly they benefit because they are in a long position and the price has risen. Well, the market is willing buyers and willing sellers, and both of them are engaged in an exchange when both of them believe that it's best in their interest. They're coming from different interests, but you don't get a buyer and seller together if they're both not happy about it. If the person that is on the long side, if that goes up, that is his property value of that goes up, and it can be real property too. And this price change is bothersome to the population. The pundits and the bureaucrats will point the finger at the speculator as opposed to the free market that is pricing a scarce good for what willing buyers and sellers pay for.
Do you think publicly traded firms have a fiduciary responsibility to their shareholders to hedge out their basis risk in raw materials and commodities as such?
Oh, absolutely. And I believe that they are big users of those markets for exactly that reason, of self-interest. And the futures market in particular is not a capital formation market like the stock markets are.
Right.
They are, in fact, the only reason they are there is to transfer risk. It's a risk transference market where some people that have risk don't want them, and speculators or others will take it on because they think they can make some money off of this. So they willingly take a risk that they didn't have before with the expectation that they will profit from this position. And the hedger who is hedging their bet in their operation, they are being prudent that they are not at the whim of the market as to whether they're going to have, good news on their balance sheet.
It's very popular for pensions to add commodities as an asset class to their investment frontier, their asset allocation. Do you consider them indexers or speculators?
Well, I believe that the institutions of endowments and pensions have as their objective is to involve their investments in a way that it will generate reliable returns to meet the obligations that they have to either the entity that it's an endowment of or the workers that it's the pensions of. And so I believe they do look very hard to find different investment vehicles which are perhaps low correlated with one another and have good reason to believe that they will continue to return good returns and independent of some of the others. So it just improves the portfolio that they have. And it doesn't mean that every chunk of their pension plan or their endowment is always making money, because it won't happen that way. But maybe the whole basket can be a better behaving basket with the diversification. And that's, of course, very, very, very well known in modern portfolio theory.
Because of the volatility in commodities prices, there's talk that the commodity markets themselves need more regulation. What's your take on that?
To my knowledge, I don't see that we have any requirement for more regulation, at least in the markets that I'm in, is regulated futures exchanges and markets. We have essentially through the clearinghouses and one thing or another, we have no counterparty risk at all. There's never been a failure in any of those markets whatsoever. It works beautiful. And so far as the public and the regulators and the government is concerned, the chief benefit of free markets are the discovery of price. What is the right market price today of this? And that's where the willing buyer and willing seller are discovering what that price is. They are price discovery markets.
Bill, you've been trading the same model essentially for 35 years. Systematic, discretionary. What's the percentages?
No, the thing that is now called the WMA model was a break-off in 1984 when we incorrectly thought that our diversified model, which we called the original, was maybe going to run out of liquidity in some of the agricultural futures. And by that time, 84, we had added through the whole markets, we had added a number of financial futures that were available, the currencies and the sovereign debt and stock indices and one thing or another. And they had huge liquidity, just massive. And we thought, well, I think I'm going to run out of these others, the capacity to. And if we did, this would not be good because we'd lose diversification. So at that time, we told new clients that if they wanted to come in, they would have to take this essentially financials only. So the WMA meant world monetary assets originally. Since that time, we have found the wrongness of our way, that not only have the other markets increased enormously in liquidity, but we studied very hard, even if they got to where we could not use as much of them as we would like, it was still a superior program to have the whole thing all the way across the board. And if and when we ran into liquidity problems, we just wouldn't have as many wheat contracts as we might want, but still it added. And of course, there's been no threat whatsoever to the financial futures. So the current thing that we call the WMA is really the original back again, and it has been that way for 15 years or so.
So in other words, you have had zero discretionary trades.
Relative to Dunn Capital Management's operation.
Yeah.
Yes, there are these two aspects, and we're 100% systematic, and we have zero discretion. And that, by the way, is a very difficult thing to live with when you just get started, because there's all sorts of information that's coming into you from the market and your psyche and all that. I'm too late on this, or this couldn't be right, or look at this loser here. I mean, I really should, I should liquidate that position rather than wait for the signals to tell me to do it. However, if you stop and think, and I did, and I was told by clients that had hired me, Bill, you trade the system and nothing else. And so I traded the system, but it didn't, it generated juices in my system. It says, I know I'm too late, I'm too early, I'm hanging on too long. But the system was the distillation of all the past data I could analyze, and that system was the best thing I knew to do for today and tomorrow. So the temptation to do it was not very strong because I knew I shouldn't. And I'm enough of a scientist that I overcame my emotion, and I just said, well, just let it play out and don't focus on the problem, focus on what we're doing right. And so that's what we do.
Dr. Dunn, I want to know which of the financial channels you have on TVs in your office, what the volume is set at, and how you implement trading the crawl off the bottom of the screen in your trading methodology.
The crawl, so to speak, or the instantaneous price that you're seeing streaming across the television screen is just a data point. And we've already got, 15, 20, 30 years of data points in our system. And we don't know when something is streaming across, we don't know what that price means. But every day we look at what all the inputs from everybody that cares all over the world has done to that. and we make a decision as to what we're going to do tomorrow. And the price is the only thing that comes into it. But it's all the prices. It's all day. It's not just this was the price a few minutes ago. So that's no information to me that is useful. It all gets distilled out through all of the pricing from all of the futures, and that's what the model uses for input, not some little tick that is on the TV screen.
So do you mean to tell me if I pulled a surprise attack and I showed up unannounced at your office in Stewart, Florida, that I wouldn't find you and Marty sitting there at your desk, double-clicking your mouse, reading the tape and try to scalp on the S&P 500s?
No, you certainly wouldn't, because we wouldn't know what to do. We would be trading the system. And whatever is going on would be reflected in the market. And we have had some experience like that. It's called 9/11, the last time it happened. And, as you know, markets were closed for a while, which wasn't very handy. And there were some big changes there before we could trade. But we traded what the price was telling us we should be doing.
Price tells you everything you need to know.
It's the only thing that goes into the model.
Wow. That's saying something. Would you call your system trend following methodology?
Yes, the WMA is based on long-term trend following. And long-term, over the course of the 35 years we've been in business, has changed from probably holding periods of typically a few months to, from 6 to 12 months now. Now that we've always, if there was a serious trend that was going on, we might take a position that would be long or short for many, many months. And the things that aren't doing that, well, we're sometimes getting signals that we should go long or short. And if it doesn't develop, then we get other signals to reverse or stand aside or whatever. But yes, it's a long-term system, and it's designed that way. And so that's what it is.
Bill, it almost sounds like you're investing in speculative vehicles when you say you have a holding period of several months. It doesn't fit the bias in the media of what a speculator or a managed futures trader would do.
Well, the holding period is a result of the model. The model didn't say, I want long holding periods. I didn't want short. So it wants to capture these not particularly popular, but very large and sustained moves, which I maintain are not anything having to do with randomness. They definitely have to do with economics, and the prices that are creating those trends are from every single interested person on both the buy and the sell side, and they're executing orders that between willing buyers and sellers, and this is the price discovery of what is really going on up to the close last night.
Bill, when you first started looking at the commodity markets in 1971, it was at a nation stage then. It wasn't like it is today. Who inspired you, if there was such a person, to get into commodity trading as a managed futures professional?
Actually, Michael, I didn't even know anybody was even trying to do what I was learning to do. And it wasn't until I got my first account that and it wasn't right away either, but I found out that there, at that time, this is back in 74, that there were perhaps 6 or 8 people that were already doing it, and doing it with a great deal of skill and success. And in fact, my first client was Heinoldt Commodities. At the time, it was the second largest futures broker in the world, right after Merrill Lynch. And they knew that what I was trying to do was doable because they had several of those traders working for Heinoldt Commodities. And so they just needed to figure out in a short time whether I could do what they knew was doable. And this was a huge, huge benefit to the futures industry, because once we had these independent traders that did not work for the company but used the company's assets for seed money, or then they went out and put out partnerships to raise capital. And now we had an independent trader and the futures broker who was collecting the fees for being a broker, and the investors who were collecting profits. This was the first time that they had ever had a system that was win, win, win. So they were over the crash and burn system. They had a deal that everybody could win on. And I was quite amazed when I found out that there were other people already doing it.
Bill, what advice could you give to the new trader, the aspiring trader who wanted to do a trend-following, technical-style methodology to trade the commodities markets, besides read Reason Magazine?
Free minds and free markets. Right?
Exactly.
Well, I think I can only talk from the technical approach. I wouldn't know about the fundamental. I don't think I have any capability whatsoever of analyzing fundamentals and having any chance of thinking that I knew what was going to happen tomorrow or next week. So I just don't even try. So a person that would like to get into doing something like this and was willing to, or wanted to investigate technical trading, I think they first have to decide what it is that they're looking to capture, whether it's long-term trend following. By the way, long-term trend following has always had the attraction, which is why there have been so many people that have done it that way, is that it insists that you position yourself with the trend. The trend's your friend. And if it's going to go someplace, you're going to stick there and you're going to make some money. And it also has the discipline is if you're long and this is going going down, there's a limit to how much pain I'm willing to suffer. And so you cut your losses short. So whereas a fundamentalist, if he thinks it's supposed to go up and he's bought and it goes lower, he sometimes gets the idea it's even a better deal now. And so he will argue with the market. And that is a very popular way to fail, is that you argue too much and too long and you pick up big losses, whereas the trend followers have a few real large wins and quite a few small losses. So the trend follower has a great deal of survivability built into it. So the new aspiring technician needs to build the model, or the concept for the model that he thinks he can be comfortable with and trade, and then he has to do whatever testing is necessary to convince him that he has a sound grip on what his model will do, and that he is in a position to execute these trades for the long run, and he has enough background and backup and reserves that he will be able to do that and be able to look at the long term. And so it's a matter of personal commitment and discipline.
At one time, behind his desk, Paul Tudor Jones had a sign that said, "Losers average losers." I don't want to make any ad hominem attacks. So to summarize, a trader would have to get the concept of mathematical expectation versus accuracy on the model side, but then all the while have the emotional constitution to execute that model like you've done over 35 years.
Right. And it's very tempting to be driven by the immediacy, but you don't have any research on the immediacy, and you have loads of research on lots and lots and lots of the past, which had you lived it, you would have had the same juices flowing through you. But since you didn't have to, you can be objective. So why not do that for tomorrow?
Just put your stops in and let the market come to you.
If that's the system to have stops in it, yes.
Bill, what do you like to read outside of stuff for work?
I probably spend a lot of my reading time that's not business-wise about liberty and freedom and the social systems that promote it and tend very largely to reduce poverty and stress and grow healthy populations of free people. And so I read about the philosophy and the economics of capitalism.
So you haven't wandered too far off the reason farm, so to speak, with your reading list.
That seems fair to say.
Bill, thanks for speaking with me today. Thanks for your time. So there you have it, Bill Dunn in his own words, master commodity trader and chairman of Reason Foundation. Free minds and free markets. I'm Michael Martin. Thanks for watching. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.